What's up, welcome back to another video. In this video I'm going to be showing you guys a very important lesson. I'm going to be teaching you how you're going to use liquidity and ultimately be able to tell where price action is going to go. So this isn't going to be a specific strategy. This works with many different strategies. This is just going to be how you use the liquidity to find where price action is most likely one to go. Now you can use this for your daily bias. You can use this if you're lower time trading on the lower time frame. This is just extremely important stuff to know. But first of all, I'll just go over the different types of liquidity for if you're unfamiliar with that. So there are three main different types of liquidity. The first type of liquidity is trendline liquidity. Now all this means is when there is a trend line created, a retail trend line, there is just liquidity sitting below or above these points. So right here, this is an example of liquidity sitting below this point. So all that means is retail traders and stop losses will ultimately be placed here. Because as you guys know, the retail traders use these fair value gaps to enter long positions. So there are stop losses all below this point here. Imagine these are all candles. There are stop losses all below here. So what price action will most likely want to do is have a run on this liquidity. So price will go up, take in all the buy side liquidity. Then price may want to go down and take all the sell side liquidity before then going back up for buy side liquidity. So that is just one example. And if you don't know what buy side and sell side liquidity means, buy side liquidity is just buy stops and sell side liquidity is just sell stops in the market. So that is the first type of liquidity. You then have equal lows and equal highs. That looks something like this. So this is an example of equal highs. Now all that means is when price action has came to the same point more than once in a different time frame and doesn't sweep the high or the low. So right here, as you can see, imagine these lines are all candles again. Price comes up to this point here, taps this point right here, and then price also comes to the exact same point in the market right here. And this is just a big draw on liquidity, and price is like a magnet. Just imagine liquidity as a magnet for where price action wants to go. And then you have just swing highs and swing lows. So let's say this is price action like this. You would have buy side liquidity up here, and you would have a sell side liquidity down here. So this is just an example of swing highs and swing lows liquidity in the market. Okay, so then if we go to the 5-minute time frame, first of all, let's just go to the 1-minute time frame, and I'll explain what happened to on yesterday's price action. So here we have open from yesterday. Now as you can see, where would we have our buy side and sell side liquidity here? So right here, I would mark out buy side liquidity, and then here I would mark out sell side liquidity, So now you might be wondering, okay, in this instance, in this example, how would I know if price action wants to go for either buy side liquidity or sell side liquidity? And the answer is quite simple. So doesn't matter what your day trading strategy is, okay? What you want to be able to do is use fair value gaps and different ICT PD arrays to be able to tell if it is being respected or not. So let's say you trade order blocks. Okay, so right here we have a bullish order block, and as you can see, price is reacting off of the bullish order block. So then if price keeps respecting this bullish order block, price action is most likely want to go up. We also have a fair value gap here, a bearish fair value gap. So if this fair value gap's got inversed, then where would price action most likely want to go? for buy side liquidity. So this is actually the model that I trade is the inversion model. I have a full trading course on it, so if you're interested in that, look at the link in the description. So yeah, so if this 2-minute candle got inversed, I then know that price action is most likely going to want to go for this buy side liquidity. So as we can see here, we've inversed this 2-minute fair value gap. We have took this buy side liquidity now. Now you might be wondering, okay, how do we know if price wants to keep shooting upwards and taking out more buy side liquidity, or if price is going to come back and reverse? Now, one good way you want to know this is by seeing if there is displacement or not above the high. So right here we have buy side liquidity. So what you want to see is if we displace and keep going up quickly, which all I mean by displace is just getting a nice bullish candle that has a strong candle close. Or if we just wick the highs and then reject, then that is a very good sign that we are most likely going to come back and reverse. So as you can see right here on the higher time frame, and another thing I just want to slide in there is if it is on the higher time frame, then you are a lot more likely to tell the bias. So if we look at this 1 minute, it looks like we are getting nice strong candle closes above. But then if we go to the 5 minute, for example, as you can see, we are clearly wicking those highs. Now, just from these wicks alone, you can't 100% be sure where liquidity is going to go, but you can have a good idea. So as I just said, we've took buy side liquidity. We have failed to displace over it twice. So just from this information alone here, we can already tell that we have a high chance that we might want to come back down and take some sell side liquidity, which we do. So then on the 5 minute time frame, what can we see? Just as we take sell side liquidity, so here we've now took buy side liquidity and we've now took sell side liquidity. So you might be wondering, okay, what now? How do we know if we are going to go up for buy side liquidity or if we're going to go back down for sell side liquidity? And the way you want to do is, as you can see on the 5 minute time frame, we have this bearish 5 minute fair value gap. So what I would do is I'd wait for price action to come up here and tap into this fair value gap, and I would see if we got either a close above this fair value gap. If we got a candle close above this fair value gap, then I would most likely think, okay, we are disrespecting this bearish fair value gap, so we are now most likely going to go up to this buy side liquidity. Whereas if we just wick into this fair value gap and hold this bearish fair value gap, where are we most likely going to go? We're just most likely to go to keep carrying on going down. As you can see, we wick into the fair value gap. We also inverse this 1 minute fair value gap, and then we come straight down for more sell side liquidity. Okay, so that is just how one quick example of how you're going to use liquidity, use the markets to tell you where you think price action is going to go. Remember, I do sell a trading course which teaches you how to trade this inversion fair value gap model. So if you are interested in that, then make sure you click the link in the description. It'll take you to the website and you can get started learning that. So yeah, thank you guys for watching.